Okay, let's look at this problem on external financing needs. You all had a different problem, and on this income statement, there was an error. So some of you corrected the error, some of you left it like it was and worked the problem. Some of you spent so much time trying to figure out why it didn't match up that you didn't have time to finish. So I just gave everyone full credit for this. But you will have to work one of these on your exam, so let's go through and take one of these examples and work through it. So you'll have another example of how these are worked. Now, each person had a different input on theirs. For this particular problem, everybody had the same income statement and balance sheet, but you had different assumptions. So for this particular problem, sales are assumed to grow by 15%. Cost of goods sold and SG&A move directly with sales, operating at full capacity. For this particular problem, dividend payout was assumed at 70% of income. Stock was currently trading for $5 a share, and there are 30 million shares outstanding. So as of 2025, we have 30 million shares outstanding at $5 a share, and that's going to be different for each of the different variations of this problem, but on all of them, the SG&A and the cost of goods sold, when you subtract that out, it should have been 270 instead of 170. But rather than change the whole income statement, I just made the SG&A 200 instead of 100. So now I'm just going to work through this problem. So if the sales grow by 15%, and your cost of goods sold and SG&A remain constant as a percent of sales, then they would go up by 15% as well. So if everything in the top part increases by 15%, that means your earnings before interest and taxes will go up by 15%. Now, on one of the problems we worked before, it told you what percent cost of goods sold made up of sales. So on your exam, you might be given an assumption for one of these operating costs as a percent of sales. So you'd have to multiply that by the sales to figure out the cost of goods sold. In this case, it told you cost of goods sold and SG&A increased directly with sales. Now, when we get beyond the earnings before interest and taxes, the interest expense doesn't automatically go up with sales. It goes up if you use more debt. And at this point, we don't even know if we need to use more debt or if we want to use more debt. So we leave the interest expense the same until we go through that feedback loop like you did and figure out how we're going to finance it. So that gives us taxable income on this one of 166. The assumption for tax rate was 21%. So 21% of 166, we subtract out the taxes of 35. And on this problem, we're assuming a dividend payout ratio of 70%. So 70% of 131 is 92. And I just rounded all of these numbers up so we didn't have decimals to deal with. So the amount that's left over after the dividends are paid, that's used to buy new assets. And so on your balance sheet, part of that is going to be used to increase those assets. And on the right-hand side, where we record where did the money come from, we add that to the retained earnings on the right-hand side of the balance sheet. So 39 plus 210 gives us an estimate of retained earnings for 2026 of 250, in this case, millions. So in the problem, it said that your company is operating at full capacity, and so that means all assets are going to move directly with sales. We're going to adjust that assumption in the last problem, but in the first round, we're going to just take each one of these and increase them by 15%.